In 2025, the United States government has introduced a sweeping set of tariffs targeting goods imported from major global economies including China, the European Union, and parts of Latin America and Asia. This aggressive trade policy is intended to revive domestic manufacturing, protect American jobs, and reduce dependence on foreign supply chains. But what is the real impact of these tariffs on the U.S. economy and the stock market? At first glance, the policy may seem protective, encouraging American consumers to buy locally and giving U.S.-based companies a competitive edge. However, the situation is far more complex. Economic impact. These tariffs are essentially taxes on imports, which means American businesses that rely on foreign raw materials and components are now paying more for the same goods. This leads to increased production costs, which are often passed on to consumers in the form of higher prices. As a result, inflation is starting to climb, putting pressure on household budgets and reducing consumer spending power. Certain industries, such as construction, automotive, and technology, are being hit particularly hard. These sectors depend heavily on global supply chains, and now they're facing shortages, delays, and rising operational costs. Meanwhile, American farmers and exporters are dealing with retaliatory tariffs from other countries, reducing demand for U.S. goods abroad. Stock market reaction. The stock market has been extremely volatile since the announcement of the tariffs. Investors are nervous about the long-term impact on corporate earnings, especially for multinational companies. The S&P 500 and NASDAQ have seen sharp drops in sectors like tech, retail, and industrials, while some domestic manufacturers and energy companies have seen short-term gains. The overall sentiment is cautious. Wall Street hates uncertainty, and trade tensions create exactly that. Markets respond not only to data but to expectations. If businesses and investors expect a prolonged trade war, they may cut back on hiring, investment, and expansion, all of which can slow economic growth further. Broader implications. Economists warn that if this pattern continues, the U.S. could be headed towards slower growth, weaker consumer confidence, and potentially even a mild recession. What started as a strategy to boost American industry might end up hurting it, especially if global supply chains continue to unravel and key trading relationships deteriorate. While the idea of economic protectionism may appeal to some voters and policymakers, the real-world effects are mixed and, in many cases, painful. The global economy is deeply interconnected, and any disruption to trade flows has ripple effects that are hard to contain. As the situation evolves, investors, businesses, and everyday Americans will be watching closely to see how Washington responds and whether there's a path to de-escalation and economic stability.